Welcome to the lecture on two-stage dividend growth and preferred stocks. So, how to find these cost stock value when there is two-stage dividend growth, or also we also will try to have the other methods for the common stock valuation, and then in the end we will also know about how to find the cost valuation stock valuation in the case of preferred stocks. So, as you know that if at some point earnings and dividends go up to exhibit a very high growth and G becomes more than R, then this Gordon's formula would produce a negative value of the stock. So, basically you have to use the two-stage growth formula, and stock value is estimated by combining the present value of dividends from year 1 to n with the present value of dividends from n plus 1 to infinity. So, we have to do in the two stages when the G becomes more than R. In that case, you will have to find the use the formula based on that. So, if you look at the formula tells like you have P naught. So, P naught will be D naught, and then that will be multiplied by 1 minus, then you have 1 plus G 1, and so G 1 and you have G 2, there are two growth rates. So, 1 plus G 1 and then that divided by 1 plus R. So, that will be and that will be divided by, so that will be powered n and divided by R minus G 1, and this will be again multiplied by 1 plus G 1. That is what we had seen earlier, that you have this is D 1. So, D naught into 1 plus G 1. So, that will be that, and then this is the formula for the first period, and then further from n plus 1 to infinity it will so n plus 1 onwards it will go. So, d n plus 1, so it goes for the infinity period. So, you have only 1 by R that effective term. So, it will be 1 by R minus G 2, and then it will be 1 by 1 plus R raised to the power n. So, this way you get this value of the current price of the stock. So, this also can be understood with one example. Suppose you have the current price per share of is for any corporation is to be found out, and so current price to be found, and in that case you are given that these annual dividends. So, annual dividends are growing, so are expected to grow by 25% for next 5 years. So, this such conditions are given, and slow back to 5% after that. Now, in that case it is given that the dividend is rupees 37 per share, and required rate of return is 15%. Now, in such cases we know that your this 15% is nothing but the R. So, we know that R is becoming 0.15. Now, in the first period for the for first 5 years it is 25%. So, G 1 will be 0.25 and n will be 5. So, that will be used in this formula for the first period, and then you have the G 2 comes into picture. So, G 2 will be it is comes down to 5% after that. So, G 2 will be 0.05, and in that case your n will be certainly after that, since you are going towards the after that it goes for for the larger period. So, this is all about the data, and you are given D naught as 37. So, with this formula you can find the P naught, and P naught will be in that case you can find. So, it will be 37, and then you will have 1 minus. So, it will be 1 plus G 1 by 1 plus R. So, it will be 1 plus G 1 is 0.25, and then divided by 1 plus 0.15. So, this raised to the power n. So, this is for 5 years. So, it will be done with 5, and then you have R minus G 1. So, it will be 0.15 minus 0.25. So, this term also becomes negative, and this also becomes negative. So, that basically cancels, and 1 plus G 1 will be 1 plus 0.25. Then the second stage growth, for that you will have this value remains the same. So, you will have 37 again, and 1 by R minus G 2. So, R is 0.15 and G 2 is 0.05. So, it will be 1 by 0.0. So, it will be 0.15 minus 0.05. So, it will be 0.10, and then it will be 1 by 1 plus R raised to the power n. So, it will be 1 by 1.15 and raised to the power 5. So, this way you can calculate the P naught value, and it will be coming close to 828.69. So, this is how you solve such kind of problems when you have the two stage growths, or your different stages growths in the case of dividends, and also the dividends how they grow. So, that is how you calculate. Now, we have to find the other methods of cost evaluation, and the other methods of cost evaluations include the price by earning ratio model, then book value per share method, then liquidation value per share method, and all that. So, that we will be discussing. So, among the methods which are as we discussed, that it will be the price by earning ratio multiples method. Then you have other methods like book value per share and liquidation value per share, all that methods are there. So, if we try to see that how these methods work. Now, the first is the price by earning. So, price by earning ratio. So, that is known as P by E. So, that is P by E multiples method. Now, in this case what is done is the value of the value VC, that is found, and this will be basically found as the earning per share. So, that is this is expected earning per share of the company. So, that is why it is written as EPS E, and that will be so this is value of the common stock. So, that is why we are writing VC. So, expected this is earning per share of the expected earning per share of the company, and then that will be multiplied by the P by EI. So, this is price by earning ratio. So, that is P by EI of the industry. So, this way we calculate the value of the this common stock. Now, it is more suited for the firms which are not publicly traded. So, you can say that suppose you have a train service corporation is there, and it is expecting. So, a corporation expects it expects its earning per share. So, earning per share to be rupees 3.10. Now, so that the price by earning ratio is related to 9. So that the price by earning ratio so is rated at 9. So, and I mean it is basically at a time. So, not that so that it is at a time when you have the price by earning ratio is rated at 9. Now, what will be the good estimation of the value of the share in that company? So, in that case you have to find the VC. Now, you know that we can simply find VC as the EPS. So, EPS is said to be 3.10, and then price by earning ratio it is expected to be at 9. So, you will multiply with 9. So, it will be 27.90. So, that way this price by earning multiples method works. There is another value that is known as the book value per share method. So, this method based on certain hypothetical situation, and in this it is estimated, it is this gives a good estimation of the value of a share in the firm, and it will be thinking about the what will be the for the share, what will be the stockholders per capita share of all the firm's assets. So, basically it hypothetically assumes that the firm's all the firm's net proceeds and all the assets are liquidated, and all the liabilities including the preferred stocks, they are paid. So, basically what it tells that if suppose all the assets are liquidated and all the preferred stocks all the liabilities like preferred stocks, they are paid. In that case what will be the firm would be the stockholders per capita. So, that finding that way you try to find the cost of the share. So, so in this case the value will be there, so it will be in the firm's books, and that is why it is known as the book value method. So, that is basically the case of it's basically it's a case of hypothetical in nature. So, it's not that actually it has the firm has already liquidated or it has paid all its liabilities, but you assume and that way you calculate its value. Like maybe for some companies, if suppose its total assets. So, suppose the company's total asset of a company, so that is estimated, and total asset is estimated to be 2.7 million. So, 2.7 million rupees, and suppose liabilities. So, if you find it has been calculated that if suppose total liabilities, they are the 1.2 million. Now, in this case companies preferred stock dividends. So, companies preferred stock. So, that dividends and this is calculated, and this is calculated as 6,50,000. So, and also it has 85,000 common stocks. So, the company has 85,000 common stocks. So, what will be the value of this share? So, if you have to calculate, in that case you have 85 this is 85,000 common stocks. So, what you will do is in this case you are going to have the asset as 2.7 million, 27 lakh. Now, from that you have to subtract these liabilities, that is one is your 1.2 million, and then the preferred stock dividends, they are 6,50,000. So, you have 12 lakh plus 6,50,000. So, this 6,50,000 plus 12 lakh, that is to be paid. So, that is that has to be paid out of 2.7 million. So, that is 27 million. So, basically in this case if you have to find the VC, so it will be basically 27 lakh minus, you are going to add these liabilities, liabilities 1.2 million plus company's preferred stock dividend, that is 6.5 lakhs. So, it will be 18,500,000. So, that will be subtracted, and then for every shares price, if you have to find or value, then you have to divide with the number of shares, that is 85,000. So, if you calculate this value will roughly come out to be 1,000. So, it is coming as 1,000 because it is 8,50,000 divided by 80, no, this is 10 basically. So, 8,50,000 by 85,000. So, it is 10 rupees. So, it will be 10 rupees 10. So, that is the value of every share that you calculate. So, and this is basically all these are recorded in the firm's books. So, that is why it is known as the book value method. What is the value which is remaining at this point of time. So, that is why it is the book value method. Then the another method which is also important is the liquidation value. So, this is liquidation value per share. Now, in the earlier case using the book value method, you are assuming hypothetically that the liabilities are to be paid, assets are to be sold. Now, in this case it will be similar to the book value method, but the only thing is that this is for the actual case, not the hypothetical case. So, it is about the value of a share in a firm that is actually being liquidated. So, for that you have to work based on these data which you have. Suppose a firm is there and its team is responsible for handling the firm's assets liquidation, and it has reported that 2.3 million would remain after they pay after they pay all the liabilities. So, once you pay all the liabilities, then you have remaining with you 2.3 million. So, that is with you, and then you have all these remaining proceeds are to be distributed among the number of shares present. So, if the number of shares are 1,10,000, in that case the value of the share can be found. So, you have to find the net proceeds, to find net proceeds, and if suppose they are finding, the team has done the homework and it has found that suppose the company has 2.3 million remaining. So, remaining after all the paying all the debts and all that liabilities, and you have a number of shares as 1,10,000. So, then what you will do is that you are going to divide and you are going to get the volume value of the common stock, that is share, and it will be 23 lakhs and divided by 1,10,000. So, that will be something close to 20.91 rupees per share will be the value as per these. So, once your department or the term or the team of the experts, they have worked on all these data and they found that this is how you are having the remaining of this much of amount which is remaining. In that case, you are going to calculate this VC by dividing with the number of shares. So, this is all about the finding the values for the common stocks. Now, we will come to the preferred stocks and what we see that in the case of preferred stock, they do not have any maturity date and it pays a fixed dividend for as long as the stock is outstanding. And that is why the payment of dividends can be considered a perpetuity. So, as we have understood that they do not have a time of maturity and as long as the firm continues, they will be its part. So, that basically is a concept of perpetuity for the infinite time they will be with the company. And in that case, you have the cost of preferred stock. Basically, you have the when you find the price of these stocks, we represent with PP. So, price for the preferred stocks, so that is PP. For common stock, we write PC. Similarly, the rate of return for the common we had studied discussed many times RC, but here we will use the term RP. So, and also we know that when you have the things go in perpetuity, in that case whatever be the dividend, dividend will be divided by this rate, that will be the amount of the current price. So, that will be that is how the price is calculated. So, in those cases when you are trying to find, so in case of for preferred stocks. So, if you will take for preferred stocks valuation, if you do, so the formula becomes PP for the preferred stocks, its price, it will be DP. So, that is your dividend which is being paid for the preferred stock and it will be multiplied with 1 by RP. So, that is how you get the value of the PP and so PP will be DP by RP. So, for example, suppose a company has a so if suppose there is one company which has paid a fixed annual dividend. So, a company so that pays fixed annual dividend so there is some amount that is suppose of $7.50 and to their preferred stockholders. So, as we have understood that company has to pay them first. So, that is your preferred stockholders. Now, what will be the value of the preferred stock if the required rate of. So, if the required rate of return for the preferred stock is 14.5%, then what will be the value of the this preferred stock. So, value of the preferred stock, price of the preferred stock, it will be dividend divided by the rate. So, dividend is 7.50 and rate is 14.5%. So, it will be 0.145. So, that becomes 51.72. So, $51.72 is the price or the value of the preferred stock in such cases. Now, we also should know something more about the preferred stocks. When we talk about the preferred stocks, there is a terminology that is cost of preferred stock, and this cost of preferred stock is represented by the required rate of return, that is your RP. And we know that from the same formula, if you try to see RP will be your DP by PP. So, if you talk about the cost of preferred stock, so we know that you get this Rp as you know the dP by pp. So, this will be a dividend for the preferred stock divided by the price of the preferred stock. Now, instead of using this preferred value preferred stock value as pp, we also use the term net proceeds, because you will have you will have to subtract the flotation charges. So, basically you have to find the net proceeds. So, that will be your NP, and NP will be nothing but the preferred stock price minus flotation cost. So, flotation cost is there while transacting with these shares, and so your actual equation for the Rp becomes dP by NP. So, when the flotation cost is also involved, and when you have to deal with that, in that case the flotation cost has to be incorporated in the formula to find the NP net proceeds, and the Rp will be the ratio of the the dividend for the preferred stock divided by the net proceeds. So, for example, suppose there is a company is there and it pays out 9% of its stock. So, it will be paying. So, if a company pays out 9% of its stock par value of $96 as dividend of preferred stock. %9 as preferred stock, given that cost to issue and sell, and the cost to issue and sell is $4. Now, in that case, what will be the cost of stock? So, we know that it is using the 9%. So, 9% will be so dP will be 9% of the 96. So, that will be your 8.64. Now, the NP, that is your net proceed will be 96 minus 4. So, that will be your 4 is the the FC, that is your flotation cost. So, that is your for issuing for the issue and sell. So, it is coming as 92. So, your rate of return, if you find if you are interested for the preferred stock, it will be dP by NP. So, 8.64 by 92. So, if you take its value, it will be coming as 9.4%. So, that is the rate of return for the preferred stock, and that is how you calculate the value of the preferred stock. So, what we have so far understood, that there are many points which needs to be kept in mind while dealing with these valuation of the stock or the cost of the stocks, for be it the common stocks or be it the preferred stocks, and how to find, because there will be the flotation cost involved, and how to calculate. Then also we studied about the growth in the dividends, and growth also in once the growth rate is constant or the growth rate has changed in stages. So, in those cases we have used the different formulas for finding the value of the price, of the cost stock. So, all these formulas we have studied about the interest factors, and basically they are instrumental in giving you all these expressions or recalling you all these expressions, because you are using these present worth values, using the future values. So, you are basically finding those you are using these factors to find the current price of the share or the stock or so. So, that way you have to have the clear understanding of which formula to be used, and especially when your growth rate is given and growth rate is changing. So, in those cases how to use the formula, that must be kept in mind, so that you can efficiently use these formulas and get the required results. Thank you very much.